Alright guys, happy Sunday. I'm in the office, I got Wiz Khalifa playing, so we'll jump into the weekly watch this video here for the week of June 21st. So keep in mind the market is closed tomorrow, but I will cut straight to the chase here guys. I'm looking for reasons that can lead me to believe the market isn't going to continue to roll over here, but I'm not finding too many signs. As a matter of fact, I'll show you my notes here, and I try not to curse too much on the channel. But as far as the S&P goes, here's my notes. Weekly squeeze firing short. If the bulls can't get it back above 380 plus, this thing is fucked. So, that is how I'm seeing things, guys. But as far as a few observations here, none more important than the weekly squeeze that fired short last week. So granted, the S&P's pulled back from 480 to 375, right, so $100 pullback. It's a pretty good haircut. But when a weekly squeeze fires short, we're looking for 5 to 8 plus weeks of continuation to the downside. So that's not good for the bulls. And again, if they can't get it back above 380, which I think is asking a lot here, so it's not like that's a small task, but just based on the structure, based on the squeeze, based on the signals here, if the bulls can't get the S&Ps back above 380, then I think this coming week, guys, we're going to see the market test the weekly 200 at 350. So as you're taking your notes here, those are two important levels. Under 380, the probabilities point towards we're heading down towards that weekly 200 at 350. And that's a good 4% under Friday's closing price. So the weekly charts certainly point towards more downside, and then things don't get any prettier here with the daily charts. So if there's one thing the bulls might have working in their favor, and I'm not sure if it matters, but if there's one thing they have in their back pocket, it's pretty much just the fact that we are oversold as hell. So what is oversold as hell, you might ask? Right now, the S&Ps are about 8% under the daily 21 EMA. So in terms of probabilities, right, for starters, not necessarily the spot where you want to load up on swing trades to the downside. So we're looking for a flush next week, and we can trade it. But here's where you got to be a little bit cautious, buying puts or selling call credit spreads, and then going to the beach for a week. That feels a little bit risky here. So generally speaking, when you're 8% under that 21 EMA, like we were back here in January and February, yeah, you tend to get a pretty good kickback. Right? Call it a short squeeze. And for what it's worth, I think the only chance the bulls have here this week is some kind of short squeeze. So food for thought there. So that's the one thing you can kind of give the bulls right now. Everyone's short and we're deeply oversold. I'm not sure if that's going to be enough, though, to trigger a bounce here in the market. Then if you look at the signals with the big 3 bars, we have the bearish big 3 bar on the daily chart. And then if you look at the multi-tab over here, you got the sell signal on the daily 4-hour, 2-hour, 1-hour, 30-minute chart. So we're going into the week with the S&Ps firing a weekly squeeze short, under major trend support at 380, and you've got sell signals on the daily down to the 30-minute chart. So the weekly, the daily, the 4-hour, 2-hour, 60-minute, 30-minute, they all suggest the path of least resistance is to the downside. So weekly squeezes fire short, taking out major levels of support. You got active sell signals on pretty much every time frame, and this is the case for the S&Ps and the QQQ. Same thing here, and the IWM. So as far as the indices go, guys, sell signals, squeezes firing short, no major support anywhere close, all kind of points towards more downside. Again, you got to be careful getting short here for a swing trade, because there is that potential of a snapback rally, but all things point towards lower prices. Alright, so there's a quick look at the indices. Now, another issue here for the bulls is that the US dollar is one of the more bullish looking trends out there. So one of the few things left in the market printing the bullish big 3 bar. And you got the bullish big 3 bar on the daily chart, on the 4-hour chart, the 2-hour chart, and even the 1-hour chart. So the US dollar here from top to bottom, the signal suggests it's gearing up for more upside. So understand the implications here. A strong US dollar is not good for the overall market. Strong dollar typically means weak equities market. So in plain English, If you're bullish on the S&Ps or the QQQ, you don't want to see the dollar trade higher here this week. As far as the structure and the signals suggest, this kind of feels like back here in April. You have the active buy signal, you have the daily squeeze, and like any other daily squeeze of the buy signal, you got the continuation into new highs. So this week, if I'm bullish on the S&Ps, I need to see that dollar breaking hard, ideally back under that daily 21 EMA. But the signals suggest you're going to see this trade higher. So for now, I think you want to have faith in this signal. And if the signal says higher, that does point towards more downside for the overall market. So throw that into your watch list. If the dollar holds above 104 and we have the active buy signal, you've got to be thinking the market's going to trade lower. The only chance the bulls have here is the dollar back under that 21 EMA. So for now, that points towards more trouble here for your U.S. market. Then you've got the volatility index, the VIX, which of course plays a really big role in this market. As far as the VIX goes, guys, this still kind of sets up here for another rip towards the upside. And I think eventually you're going to see the VIX up here towards 40. So there's an issue. The market's deeply oversold. You've got the U.S. dollar looking like it wants to break out. And you still have the volatility index here looking like it's setting up for another push towards the upside. So that's another issue. So along with the U.S. dollar breaking down, if I'm trying to see a bounce in the market, I need to see the VIX cracking 30, cracking 29, then continuing to crack even lower. You can't have the dollar and the VIX both looking nice and pretty here, looking all kinds of bullish, if you're trying to get a bounce in the overall market. So put that on your watch list. VIX back under 29, 28, US dollar back under 104-ish, then maybe you get a big rally here in the market from these deeply oversold levels. But the VIX looks like it wants higher. And then the last observation here, guys, is the last 2 to 3 to 4 months, you've had your leadership here in energy, natural gas, and U.S. oil. And we're starting to see some problems here as well. So what's awesome about this, the indicator here, the big 3 bars, of course it helps us focus on, good entries, and it helps us kind of, create that watch list and identify the things we want to trade. But more importantly, it also offers some warning signs. For example, when the energy sector here, XLE, last week you'd lose that active buy signal, right? No more green big 3 bar. That's an issue. That's my first potential heads up. Things might be getting a little bit suspect here. So check this out. Let me get my notepad up. But as far as energy goes and natural gas, both of them, they stopped printing the buy signal last week. Then they started breaking down pretty good. So the energy sector, that stops printing the green big 3 bar on the 13th. Then it proceeds to pull back about 14% in a few days. This looks pretty busted, right? Let me change this back to the daily 50 here. But down goes the leader. Down goes the leader. Yeah, this is busted, guys. No more buy signal on the daily chart. We have bearish big 3 on the hourly, 30-minute, 15-minute. No positively stacked EMAs. Negative histogram. We're under the 50. And we're under that daily 21 EMA. None of that is bullish. The point I'm trying to make, though, I don't want to continue to buy the dip and have to wait for a 14% pullback to get a pretty good sense that it's not bullish anymore. Right? So my first warning sign last week was the fact that we no longer had the daily buy signal. That's an issue. That is an issue. So if you look at a name like Valero, one of the strongest names in energy, and pretty much you look back at like April, all the way up until recently, this has been a good buy the dip opportunity. Pretty much that bullish playbook, right? Buying the dip to the daily 21, getting long the daily squeezes, trading lower time frame squeezes to the upside. Those things work really well when you have the green bar. And remember what that signal means. We got a green bar on the daily chart. That means both the weekly and the daily chart, they meet all my criteria. Right? I'm looking for 6 or 7 things to line up. They all line up on the daily and the weekly only when you have the green bar. So as soon as you lose the green bar, something changed, right? Something between the relationship of the trend, the structure, the momentum of both the weekly and the daily. Something changed here. So again, that's my first heads up that potentially it might be time to stop buying the dip in energy. So Valero, they lose the buy signal on the 15th. That pulls back by 18% in 3 days. I don't want to take that haircut. I want to get out of there way before that big breakdown. Then you've got Oxy. Our good old Oxy here. Beautiful trend. You had the active buy signal since February, and you want to buy those dips. You want to get long in the daily squeeze. You want to take the 4-hour squeezes. You want to buy the dip to the daily 50. That bullish playbook works really well until you lose the buy signal. So Oxy loses the buy signal on the 13th. Then she pulls back a good 9 to 10%. Then you got MPC, right? One more example here. But MPC is a great example of a name where pretty much since March, you want to be long. You want to get long the daily squeeze. You want to buy the dip to the 21. You want to look for higher prices. Soon as that green bar disappears, you got to get a little bit cautious. So this loses the buy signal on the 15th, pulls back by like 17% in a few days. Then if you look at natural gas, another great example. Buy the dip until you lose your buy signal. You lose your buy signal, might be time to step back. And I think looking at natural gas here for now, for me, time to step back and avoid getting long. We're under the 50. You're under that 21. Daily squeeze fires short. No positively stacked EMAs. That's a big no-no. And then I got to ask myself, where's the buy signal? If I don't have it on the daily chart, maybe I can go get it on a 4-hour, maybe on a 2-hour. But then you look over here, natural gas has got nothing for us, except the sell signal, the bearish big 3 bar, on the hourly, 30-minute, 15-minute. So this communicates to us that the daily chart is saying don't buy the dip. The 4-hour chart isn't saying buy the dip. The 2-hour chart isn't saying buy the dip. And instead, the 1-hour chart, 30-minute, and the 15-minute chart, they say short the bounce. So for now, I think shorten the bounces on these lower time frames. That might be the play here as far as natural gas goes. So for now, y'all, we are not looking to get long natural gas anymore. We are no longer looking to get long energy. And a little bit of a heads up here, and I'll update you this coming week, but US oil, you're seeing a little bit of the same. Still holds good structure for now, but there's the early heads up. You lose that active buy signal on Friday, time to get a little bit cautious. Doesn't mean you short US oil. Again, it just means something is starting to change. It might mean you don't have green 10x bars anymore. It might mean that we're under the 21 EMAs. We might not have stacked EMAs. Whatever the case may be, something changes here. No buy signal on the daily. Nothing on the 4. The only suggestion right now based on the signal is your 15-minute chart saying to short the bounce. If I'm going to get bullish, especially in this market, I need buy signals all over the place. So as goofy as it might be, if you look at a name like G-O, that's an example of something I would still get long. Daily squeeze, positively stacked EMAs, but you got the full bull stack. That's a beautiful sight over here in the right-hand corner. Daily buy signal, 4-hour, 2-hour, 1-hour, 30-minute, 15-minute. You got the bullish big 3 bars, top to bottom. So this to me, okay, now this makes sense. You jump in, you buy it at the hourly 21, maybe you're trying to play that 30-minute chart, but the point being is you want to get long something where the path of least resistance is to the upside. So for little go here, the indicator suggests whether it's your daily chart down to your 15-minute, everything lining up for a little bit more upside. We had that, right? We had that dynamic in Valero. We don't anymore. We had that dynamic in Oxy. You don't anymore. And you had that dynamic in natural gas. For now, we don't. So for the last 2 to 3, maybe 4 months, guys, that's been the advice. Buy the dip in energy. Buy the dip in natural gas. Now the advice is don't buy the dip. Not saying go out there and short it, but I think we want to pump the brakes on getting long energy and natty gas until those pretty buy signals start to pop up again. So, as a quick recap there, guys, really not too many changes. I think the biggest changes here are the fact that the energy trends and natural gas is starting to break down and no longer on the bullish watch list. Aside from that, though, it's kind of just development of the structure and the trend that we've already been playing for the last handful of months here, which is a trend to the downside. So, heading into this week, if the bulls cannot get the S&Ps back above 380, and you're going to need a short squeeze. All right, so some kind of catalyst, something has to trigger that short squeeze, because as far as the structure and the signals go, whether you're looking at the S&Ps, whether you're looking at VIX, whether you're looking at the US dollar, everything does point towards more downside. So if they can't trigger the short squeeze, if they can't get the S&Ps back above 380, then I think this week, guys, we're looking for that weekly 200 down at 350. So we'll see where things open up on Tuesday. For those of you in the mastery, we are going to look for a few day trades here. But then as far as the swing trades go, that is a game of patience. So as far as swing trades to the short side, ideally we put those shorts on after a bounce here. Again, I'm looking for reasons to think we might bounce, not seeing too many. But you want to be disciplined. So, as far as a few names here that we do like for shorts, we got a short on Rivian for July expiration. You've got the sell signal, you have the bearish daily squeeze, just the major difference between Rivian and the S&P 500. The S&Ps are like 8% under that daily 21. Old Rivian here still sets up pretty good in the short, the sell zone, the entry zone. So Rivian looks like a good short. You get names like Costco out there. That sets up a good short. You've got names like, there's so many guys on the bearish watch list. It's a little bit disturbing. You've got names like Kohl's, KSS. So don't get me wrong, as far as wanting to short something for a swing trade, even though the overall market's pretty oversold, there's still, a good handful of examples out there of things we could look to short. But again, you want to be a little bit patient. So, say you like Rivian for a short. You got your downtrend, you got your squeeze, you got your sell signals. You can look to get short here, but you got to acknowledge the fact that you're getting short a stock, while the market, which is always going to be the most important thing, while the market itself is deeply oversold. Right, what I'm trying to say in plain English is, you short Rivian here, and the S&Ps do a little bit of that short squeeze action, you're probably going to see Rivian bounce. So, here's my advice. Until we get a short squeeze across the market, you can look for some shorts here, but make sure you're going about it in a forgiving fashion. What I mean is, buying 20 strike puts on Rivian, that's not going to be a very forgiving trade if the market bounces for a little bit. If instead you scale into July, August expiration, out the money call credit spreads, that's a little bit more forgiving. That's the kind of thing you can hold on, take a little bit of heat, in the event mama market's going to bounce a little bit there in the short term. So we've got some shorts on Rivian and a whole bunch of cash ready for the week ahead. But there you have it, guys. I hope you're having a good long weekend. I, for one, am a little bit bummed out. The Celtics lost last week, so I'm going to go pour myself a glass of wine and drink away my Boston Celtics sorrows. But guys, I appreciate the hell out of you. If you haven't already, go on ahead and hit subscribe. Leave me a comment down here below and let me know what you're watching this week. And I will see you guys bright and early on Wednesday morning for pre-market prep. So enjoy the rest of your long weekend, and I'll talk to you guys soon.